Hello everyone, thank you for tuning in today, and welcome to Selling Vega, a page dedicated to educating the retail investment community in order to help all of you make some money. We specialize in stock and options trading and cover all investment topics submitted by our audience. If that all sounds good, please like and subscribe to get the latest videos and begin this journey with us. Now, without further ado, let's get started. Today's video will consist of a beginner's guide to options trading, as well as how to actually trade using Robinhood. Now, I've broken up this video into segments, so if you already feel comfortable with the option basics, feel free to skip over to the Robinhood segment in the scroll bar below. Before we get into how options look on Robinhood, let's just quickly run through the basics. What all the terms mean, how an option works, and why they even exist in the first place. So, what is an option? An option is a contract that gives the option buyer the right to buy or sell stock at an agreed upon price on or before a specific date, with the option itself costing a price called the premium. Option buyers pay the premium, and option sellers will receive the premium. Now, there are two types of options, calls and puts. A call option gives the holder the right, but not the obligation, to buy shares of stock at an agreed upon price on or before a particular date. A put option is the same thing, except it gives the option holder the right to sell shares of stock at an agreed upon price on or before a particular date. The agreed upon price is what we refer to as the strike price. The specific date is what we refer to as the expiration date. And the premium price is the price of the option contract. So now that we got some of those out of the way, why don't we take a look at an example? We can start with one of the largest and well-known companies in the world, Apple. Let's say you bought a call option on Apple. So you are an option holder, and the strike price of this call option is $150 per share. It expires in 30 days, and the premium is $2 per share. Owning this call will allow you to purchase the stock at $150 anytime during the next 30 days. No matter where the stock goes. So if Apple goes up to $160 within the next 30 days, then owners of call options can buy it at $150, even though the stock is currently at $160. They would get an instant $10 per share gain, while only having to pay $2 per share to get it. Here's the thing. Owning each contract represents 100 shares of exposure to the stock you're using. So a $2 per share premium price is going to cost $200 per contract. Now let's use an example on a put. Let's say you bought a put on Apple with a strike price of $140 in 30 days, with its premium also being $2. This will allow you to sell stock at $140 anytime during the next 30 days, no matter where the stock goes. So what if the stock tanks down to $130 per share? Well, you own a put option, which gives you the right to sell it at $140, even though the current market value is $130. So you get a much better sale price, $10 better, than if you were just to sell the stock at its current price. Now again, the premium price, $2 per share, you multiply by 100 to get the cost of the contract, $200. Okay, simple enough. But why might someone actually want to purchase an option? First, we'll explain to you why you might want to buy a call. When you buy a call option, you want the stock price to go up. And more specifically, you want it to go up more than the premium that you paid for the option. Your break-even price at expiration is always the strike price plus the premium that you paid. The max gain on a call option is technically unlimited because stocks can go to infinity, although we've never seen that happen. The max loss on any call option buy is just the premium that you paid for the contract. You can only lose what you pay for it. So yes, it is a risky contract with an expiration date. However, you know going in how much you can lose. The same thing goes for put options. For put option buyers, you want the stock to go down. More specifically, you want it to go down more than the strike price minus the premium, which is going to be your break-even price at expiration. Your max gain on a put option since a stock can technically go to zero, is going to be the strike price minus the premium that you paid for it. And as always, for option buys, the max loss is always only the premium that you pay. So you know going in how much you can lose. All right, let's recap. We defined options and some of the common terms used in discussing options, like a call option, a put option, strike price, expiration date, and premium. We looked at both buying a call and a put, using an example for each one, determined what direction we want the stock to move in both scenarios, and calculated our break-even prices. Now, we talked about buying options, where you pay a premium and have the right to either buy or sell a stock on or before an expiration. What about when you sell an option? Let's talk about the other side of the market. Selling an option gives the option seller the obligation to either buy or sell shares of stock at the strike price, on or before the expiration date. The option seller receives the premium up front for taking on the risk of that obligation. You have the ability to sell a call, which gives you the obligation to sell shares at the strike price, on or before the expiration date, receiving the premium. And then there's selling a put, which gives you the obligation to buy shares at the strike price, on or before the expiration date, receiving the premium. Now let's go back to Apple and take a look at an example. If we were to sell a call, selling the 1 month call at a $150 strike price with a $2 premium, this would give you the obligation to sell 100 shares of Apple at $150 on or before the expiration date in a month. Now you've capped the upside for these shares for the next month at $150. There's always a risk that Apple could go to the moon and you're stuck selling your shares for $150. For taking on this risk, you receive the premium of $2 per share, or $200. And again, that $200 per share, that $200 per contract is paid up front as soon as you initiate the trade. Money straight to your account, folks. So how do you win? How do you make money on this trade? What's your break-even price? As long as Apple stays below the break-even price of $152, you're in the green. And if Apple stays below $150 before expiration, you get to keep the entire amount of your premium. Now let's take a look at selling a put. Selling the 1 month put at a $140 strike price with a $2 premium gives you the obligation to buy 100 shares of Apple at $140 per share on or before the expiration date, which we can see is a month. Now, even though Apple could always go lower over the next month, you will still be required to buy 100 shares at the $140 strike price. Since that is a risk you are taking on, you receive the premium of $2 per share or $200. Again, it's paid into your account as soon as you make the trade. So how do you win? How do you make money? Well, your break-even price would be the strike price minus the premium price. In this case, $138. If Apple stays above $138 at the end of the month, then you will be in the green. And better yet, if Apple stays above $140 before the end of the month, the option will expire worthless and you'll see your max gain in the account of $200 that you got at the start of the trade. So who would sell an option and why? Well, some sellers will be looking to just trade the option contract and are looking for the stock to go down or go up. But if you are an Apple shareholder and you think Apple isn't going above $150 for the next month, then you could sell a call on your shares and earn premium while you continue to hold your shares. A lot of investors use selling calls as a way to turn their portfolio into an income stream. This is called a covered call strategy, and we'll take a deeper dive into this strategy in a video coming soon. The risk to selling calls is that Apple does indeed go above the strike price of $150, let's say to $155. Well, instead of being able to sell your shares for $155, you're obligated to sell them at $150. And any stock could technically go much higher than that at any moment, which is why your max loss could be unlimited. and you must tread lightly with selling uncovered calls, or as they call them, naked calls, where you sell an Apple call without actually having 100 shares of Apple. This video series will provide you all the training needed to understand this concept, as well as the concept of risk management fully. For option put sellers, you want the stock to go up or stay above the strike price. Traders use this as a bullish strategy when they think a stock is going to go higher. There's also a large volume that comes from investors looking to acquire shares of a company and would like to earn income while they wait for the stock to hit a specific strike price they're willing to buy shares at. This is one half of one of my more favored long-term strategies. When combined with the covered call strategy, makes a powerful income-producing wheel strategy, which we'll also touch on this series. The break-even price on a put sale at expiration is the strike price minus the premium. The max gain is the premium you received up front, and the max loss is the strike price minus the premium you paid, because theoretically any stock can go to zero at any time. Alright, so are you feeling good? You ready to see what options look like in real-world scenarios? Well, let's start by pulling up Robinhood and taking a look at what the Apple option chain looks like. To get to the option chain on Robinhood, you simply type the ticker symbol or company name in the search bar at the top, in this case Apple. Now, once you get to the stock page for Apple, you can click on Trade Apple Options in order to open up the options chain. So let's find where our key terms are first. You click on either call or put to bring up the put options and call options for Apple here. And you can toggle between buying or selling. So it's pretty intuitive in order to find every aspect of the option chain that you want. The strike price is on the left side here, and you can see that they even calculate the break-even prices for you. Robinhood defaults to showing you the closest expiration date, and clicking into this bar over here will show you every option chain or maturity date for Apple. And you can see how many there are. I mean, they start going weekly, which eventually turns to monthly and will eventually go to quarterly the farther you go out. So you can see the longest date is September 15th, 2023. That's a couple years out in the future. So you can really get so many unique types of exposure on Apple using options. Clicking into each contract will give you some more detailed information. So let's take a look at one. Let's pull up that 150. It shows you. So let's go out a month and see how close our examples were to real world scenario. Let's take a look at the 150 call. And if you click into the contract, it'll show you some more detailed information, such as where it's currently trading and how many contracts traded today, how many contracts there are open currently, and some other information down at the bottom called the Greeks, which determine the price of the option contract. And we will go over the Greeks and what they mean and what it actually means for us as traders and investors in another video in this series. Clicking the price of the option contract will begin the transaction process over here on the right side. It'll show you the cost and the details of the contract. What's cool is it'll show you a profit loss chart, which gives you a visual to the max gain and max loss that we discussed earlier in the video. So that's it for beginner option trading and how it looks on Robinhood. So start to play around with this. Take a look at some option chains for yourself. And feel free to drop any questions or comments in the comment section below, so that way I can answer them or be inspired for some future video that might be helpful for you guys. Thanks again for watching. Please remember to like and subscribe to Selling Vega, as it really, really does help me and my ability to continue helping you guys. Happy trading. Let's make some money. money.